Welcome to the Vaughan Nelson podcast. Today is the first quarter 2026 Vaughan Nelson International Recap. And with me today is lead portfolio manager Adam Rich. Welcome, Adam.
Hi, Dan. Thanks for having me.
All right, Adam, let's hop right into it. But maybe a little bit before we talk through the quarter, could you just again retouch on the capital allocation framework and how that helps you evaluate not just how much companies are investing, but whether those investments are likely to generate high returns over time?
Yeah, the capital allocation framework really does two things for us. The first thing it does is it helps us find companies who are investing countercyclically. And we like those countercyclical investments while others are not because it leads to potentially higher return on invested capital. And importantly, it also helps us to avoid industries where there's too much capital going into them that might have return on invested capital falling over time.
All right, good deal. So hopping into the quarter. So nice performance for you. Nice outperformance this past quarter, and just kind of looking through some of the attribution, looked like a good deal of that was driven largely by industry positioning. Can you walk us through where allocation added value, and then maybe a little more specifically, what you're seeing in industries that you chose to avoid?
Yeah, that was a pretty crazy quarter. Obviously with the war starting in Iran, but allocation was really where there was a lot of outperformance this quarter. In particular, obviously our energy overweight was very successful. Semiconductors and semi equipment and materials, both of those contributed meaningfully to the outperformance in the first quarter. On the flip side, our overweight to banks and capital goods and financial services were detractors, and the big driver there was the private credit scare that we had. A lot of those banks were impacted by that. Most importantly, though, and this is something that we like to really touch on, industries that we avoided, where we had no exposure to, generated more than 100 basis points of alpha during the quarter. And again, part of the capital allocation framework is not just finding the companies that have great opportunities ahead of it, it's also avoiding the industries that have too much capacity. And we do find that we pick up a bunch of allocation from that.
Great. And then let's flip over to the selection side of things. Any individual stock selections, decisions that contributed positively, and then from there, where did your outcomes fall short of expectations, despite your underlying thesis?
Yeah, not surprisingly, energy stocks were the biggest contributors during the quarter. So Aker BP, Technip FMC, and YPF, those were our largest contributors. Largest detractors were Vaughan, which is a copper company, UBS, which was related to the private credit scare, and then RS Group, which was impacted by just the war and energy prices.
And then if we're taking a look at some of the extremes that we experience, can you contrast your top contributors and your top detractors for the quarter, and then maybe a little bit about what each reveals about the different stages of the capital allocation cycle?
Yeah, so let's start with Aker BP as our top contributor. This is a Norwegian oil and gas producer focused on offshore development. They've developed some great processes to really reduce the cost of finding oil offshore. They have found some significant projects that they are spending on right now. And so the opportunity that the market gave us was a few months ago as they announced these projects and the big capex cycle in order to develop them. The stock sold off because their free cash flow fell because of these investments. Well, when the oil price shot up because of the war, this completely um, changed the company's financial situation. And so what we find is these during the moments where demand or high prices create for higher oil prices, this creates for an opportunity for companies like this, where there's a lot of leverage because of these capex cycles that they're in. So the company performed very well during the quarter, not surprisingly. Top detractor was Vaughan Mines. This was a company that has found the largest copper mine in Africa over the past 10 years. And they came across some hardships. There was some seismic activity that caused some water flooding in some of their mines, and this has been an issue for them for years now, and they've been trying to resolve it. And again, this past quarter, they're still trying to fix the situation, and it's going slower than expected, and the stock detracted for us.
And then let's go through some of the changes that were made in the portfolio at a high level. Specifically how you're reallocating capital from areas that we saw declining return potential, and then to locating those companies where you believe that returns are improving?
Yeah, when volatility is high, we tend to have pretty significant turnover because that creates for a lot of opportunities. Right now, this past quarter, we did have 10 new positions and exited 10 positions. But just at a high level, we reduced our oil and semis, not surprisingly. There's just the big move in both of those industries created for some very, the valuation sells. And then we started dabbling in software and banks, and really the private credit scare and AI scare has really created for some very interesting opportunity in both of these industries that we're excited about.
All right, so you touched on a pretty good number of new positions. Anything common that you're seeing there in terms of on improving capital allocation side, return potential, and then anything that some areas that you'll be watching to ensure that those investments deliver?
Yeah, just two areas to call out. The first one was software, because I think that's very topical right now in the market. What we were looking for was software companies that were selling off were companies who had deployed AI years ago. And so we can see that their headcount was actually trending lower. And so we bought Shopify and WiseTech. Both of them have reduced or will reduce their workforce by more than 30%. And so what we see is revenue per employee exploding at these companies. And so we love that because that means their returns are going to be trending higher. Now, obviously, there's a lot of threats out there that are currently being put in the market, but we think that these companies have great ways of monetizing their software in other ways rather than just charging per seat, whether it's through processing like Shopify or pricing, getting a fee per container with global logistics with WiseTech. Additionally, one last part we want to call out. We've over the past 2 months, the geopolitics have been pretty insane, as everyone knows. But one in particular that I think has gone under the radar now that um, is seeing some pretty significant change is Venezuela. Obviously, they have redone their whole energy um, laws that really have created for foreign companies to come in and really start investing a lot faster than what people have expected. And so this is a pretty significant development in the oil world because, as everyone knows, in the previous quarters, we've been pretty bullish oil because of the CapEx cycle really slowing for these oil majors. But now we're seeing some pretty significant investments going on in Venezuela with a pretty fast ramp. That's something we're watching there.
And then on the portfolio construction side, your largest positions they reflect the highest conviction within the portfolio. What common characteristics do those companies share in terms of how they're allocating capital and improving returns? And then what would cause you to reassess those convictions?
Yeah, we've got some fantastic opportunities right now in international Shopify, which we just outlined. But in particular, this company has really done a great job in deploying AI in their business and really reducing costs. And so we're seeing ROIs explode higher, and the market is not giving them any credit for that. Siemens, we're really excited about because we think that this AI boom is actually going to create for a whole new factory. Very similar to the utility and electric build out in the United States 100 years ago, where we replaced steam with electric motors. Right now, we think the same thing is going to happen with manufacturing, with robots and AI, where you have to rejigger the whole manufacturing floor to really get significant productivity. And Siemens is at the forefront of that. Komatsu, we're really excited about too. They're equipment providers to mining and construction. The mining side is doing very well. Construction has been a headwind for them because of higher rates, but they also have a pretty good Middle East business, and so that has created an opportunity for us to be buying the stock. But as peace does prevail, hopefully soon, this will be a great opportunity for Komatsu to rebuild in the Middle East. Uh, International Container Terminal Services. This is a great little port company. They own terminals around the world, mostly in emerging markets. They are a fantastic operator. They've been deploying capital by buying more ports, and as they buy a port, their margins fall because these ports are not as efficient as their current portfolio, but over a few year periods, they really, because they're such a good operator, are able to expand margins and really drive returns for shareholders. And so we're excited about a lot of the terminals they've been deploying capital with. And lastly, YPF, it's an Argentinian integrated energy company. They own significant acreage and a shale play in Argentina. And they actually just signed a deal with Halliburton to bring all the modern technology that we have here in the U.S. down to Argentina. And so we think that they have a multi-year productivity cycle coming their way.
All right. Well, with the first quarter behind us, talking a little bit about what we're seeing in the future. What are you taking a look at from what do you think the clearest evidence is of improving returns on invested capital? Where do you remain cautious as investment activity increases? And you mentioned AI. I'd be curious about that.
Yeah, I think, just touching on AI first, we think the peak rate of change of AI infrastructure spend happens in the first quarter of this year. The numbers are still going to be staggering for the rest of the year, but the rate of change is slowing. And we think that that's going to have a material impact on a lot of these companies. This is the first time we have been short semis in the fund. And so that's a big weight in our index. And so we are short semis because of this rate of change slowing that we expect over the next 4 quarters. Additionally, so that's kind of a big one. The other thing that we think is really interesting for us is we are overweight metals in particular with copper and gold. And so we do, or with copper in particular. And so we do see, as the economy starts uh, growing again and we start getting peace and people start investing again, we should see copper demand increase significantly. Lastly, the consumer is also in a very interesting spot. There's a lot of consumer companies who have not seen any demand for many years. And we're starting to see investments really pull back, sales and marketing pull back. And so we're starting to see consumer becoming more attractive too.
All right, good deal. Well, Adam, thank you so much. And with that, we'll move over to returns. In the first quarter of 2025, I'm sorry, the first quarter of 2026, the MSCI All Country World Index returned a negative 0.71% return, and the Vaughan Nelson International Strategy returned 4.05% gross and 3.79% net. Over the past 1 year, the MSCI All Country World Index returned 24.92%, and the Vaughan Nelson International Strategy returned 53.67% gross and 52.19% net. And last, since inception, the MSCI All Country World Index is at 15.12%. The Vaughan Nelson International is at a 28.7% gross and a 27.44% net number. So with that, that's a wrap on the first quarter. So thank you so much, Adam, and we'll see you next quarter.
Thanks, Dan.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.